Just before I start with the actual topic, let me give you some key facts of Credit Suisse. I think we can say that we have a true global organization out there. We do business all around the world with quite some employees and quite some assets under management. And while this, at a first glance, looks like being a very, very interesting environment for a risk manager, because you get in contact with many different businesses out there, different risk types. The flip side is all those countries have their own regulator. And as you know, the views from regulators are not always in sync. And so you have to deal with many, many different interpretation of rules from Basel and other regulators. And that makes it quite challenging, but also very interesting. So let's enter into the topic. What I'm going to touch in this talk is, first of all, I want to give an overview about the risk types within stress testing, a couple of comments on how to choose the right approach, then enter the model risk topic, and I want to make a deep dive in challenger model, backtesting, and I want to end with some general remarks on stress testing. Okay, so to start with, many question marks. Those were originally bullets. So you can see the risk types that I wrote down, and I'm sure this kind of captures most of the risk types, but maybe you have other risk types. We have credit risk, exposure risk, market risk, earnings risk, liquidity, operational, reputational risk. As a special feature in Switzerland, we also have to stress pension funds, because the pension funds are more or less directly managed by Credit Suisse. Couple of comments for those risk types. First of all, I added two columns here, quantitative modeling, qualitative modeling. So while you can see that many of those risk types can be approached by a quantitative modeling approach, you can see that some of those that are maybe not so clear-cut also need some qualitative component on top, and these are the usual suspects. First of all, of course, PPNR, earnings stress. There you need to make some qualitative behavioral assumptions if you want to cut to the core. As we all know, the binary operational risk typically has some qualitative assumptions in the background, and of course, reputational risk, where I think a quantitative model typically fails. One comment here on interdependency. While I think that most of you cover those risk types in some form, with some form of model, I want to raise the question, and we can discuss that also afterwards. Who is modeling the interdependency of those risks? I guess many organizations get their scenarios, then the clusters calculate for a week, report it to an aggregation unit, and then the results are published. But many of those risks in stress occur sequentially, right? Maybe you have a reputational risk event, then clients withdraw their savings, which leads maybe to a liquidity risk. And maybe during that whole process, an operational risk comes on top because they just can't handle all those requests. So I think it's really important that beyond this classification of risk and beyond the individual modeling of the risk, we should also think of causalities between those risk types. And I think that's not always the case. Okay. So in this talk, I emphasize credit risk, but many of those statements are not restricted to credit risk. If you want to answer the question, which approach should I pick to model that risk? In credit risk, there are many approaches out there. You can do some regression type of techniques on the observed default rates and loss rates that you have in your history. You can do the same on your model implied estimates, PDs and LGDs. You can take your Pillar 1 models and feed in stressed inputs. Right? We had a similar discussion earlier today on through the cycle and point in time, and many of your Pillar 1 models will be through the cycle. So feeding in stressed inputs will not give you an estimate of losses, rather an estimate of how your RWA moves. There is the migration set factor approach out there, very prominent these days, also in terms of IFRS 9. Vintage and cohort approaches typically applied for consumer finance portfolios, credit cards, student loans, etc. And then you have a relatively new discipline of causal modeling, where you consciously deviate from your Pillar 1 models and from PD and LGD and really try to model each and every individual in your portfolio. And what I mean by that is that you actually look at the client's affordability, that you look at the client's vulnerability against interest rates by really looking at his contract. Is he fixed for 15 years or is he on LIBOR? And according to that, address all those client specifics to fix the issue of how your clients react. And I'm not touching the whole space of scenario creation and expansion, because that's another 40 minutes talk. Okay, so let's focus on those approaches. Question is there a most effective approach out there? And of course, kind of stating the obvious, there isn't. It depends, right? That's typically the answer that you get. And if you look at those, at this illustration top right, it typically depends on what you have at hand in terms of data. And if you kind of look at it in 2 dimensions, first of all, you have how much historic data do you have? Weak or strong data? That's probably one dimension. And the other one is the client data granularity. So your current portfolio, how good do you collect information for those clients during the approval process? And depending on the situation, you have different choices. And if you go to the green square, rich historic data, huge granularity, there basically everything works, right? You can do whatever you want. You can do regression techniques, cohort approaches, everything works. On the other hand, when you have less client granularity, but still a strong historic data, which is typically the Credit Pro data set, I think everyone is using in the credit risk space, so the US corporates that you have. Here, of course, you need to more or less focus on some well-known regression techniques. And there are other situations that kind of determine which tool you should use. But the golden statement is the data choose the model and not the other way around. And as intuitive as that might sound, it's not always the case. If you talk to colleagues, you sometimes hear, yeah, we bought this methodology from XYZ. It works pretty well. We had to squeeze in the data a little, right? Don't squeeze in data. It doesn't work. And what you can see is a simple methodology applied to a rich set of data, that works, right? You don't need to be over complex in your model choice. Because if the data are good, you can do something with it without being over sophisticated. The other way around, a fancy model applied to weak data is a risk. And it's dangerous because it gives you kind of the wrong impression of having everything under control. So it's really about data, data, and data. And one comment on if the data are not so perfect, or if you have doubts with your model choice, typically what you do is you add conservatism. If you add conservatism, you also think that everything is under control. And I have my doubts that, let's say, a wrong model based on shaky data with a huge margin of conservatism is something you should do, right? You can tick a box, you have a model, but do you really cut to the core of the problem? That is something you need to assess on a case-by-case basis. Some comments on model risk. I mean, we heard it a number of times. Yesterday and today there is SR 11.7, which probably is the most well-known guidance from the Fed that was issued in 2011, and it kind of creeped in all organizations over time, so that SR 11.7 is a buzzword in the organization. Is it SR 11.7 compliant? That's typically the question that you need to answer. And if you read through that document, it's 21 pages, so it's not a very big one. It's pretty intuitive. You can read through, and in each and every paragraph, you find something where you feel connected and you would support. So it gives very concrete guidance on model risk management. It starts with modeling, processes, implementation, monitoring, so all the aspects you typically think of. And of course, it's motivated by the last financial crisis that I guess all of us have experienced. And that was probably the reason for setting this document up. But what you also see is that the term model is used very broadly. So SR 11.7 does not distinguish between Pillar 1 or Pillar 2 models, and it does not distinguish between model types. Is that a good thing? Is that a bad thing? I don't know. But the question that you need to answer is, or let me just make that comment before we come to that question. If I ask you, and some of you are in the industry for quite some time, you probably would agree to that, right? Before 2007, a model was something that was considered to be a chance, right? You could do something with it that you couldn't do before. You already knew that it's a model. You already knew that there are shortcomings, but you could play around with a prototype or with a final implemented model, and you gained new insights, and that was perceived to be a chance. That was a good thing. If you now talk to people, be it a regulator, be it maybe an internal auditor, each and every model is considered as a threat because it could be wrong. And I have a hard time following that line of argumentation. I don't think it's a threat as long as we deal with it appropriately, in a sense that an outcome of a process must be always a mix between a model and a human being looking at the model and interpreting results. And maybe that went wrong in 2007 when we blindly believed whatever came out of some of those models. 800 basis points for a bunch of crappy homeowner loans. Okay, it's a model. It's okay, let's take it. So you could have seen that something is wrong without talking about model risk in the first place. It's just looking at results and introducing gut feeling, experience, and a bit of skepticism at some point. So, now that we are faced with this model risk guidance from the Fed and from other regulators, I think it poses an extreme burden on each and every organization out there. Right? We need to spend an enormous amount of money to get it straight. And there are positive effects, getting inventories up and running, having a better overview of the models we have. But the day-to-day business became more and more cumbersome. And the question that we need to answer is, have all models failed in the financial crisis? Right? And are all models subject to the same model risk? And I think we have broad agreement that this is not the case. But I would go a step further. If you look at and these were ticks and crosses, so green one is fine and red one is not so fine. I still remember that the single client assessments, they were okay, right? They were good. There was no problem with that. Those loans, those homeowner loans in the US were given to people who shouldn't buy a house. The FICOs were bad, the LTVs were high, so all the key risk indicators indicated that there is something wrong. Those mortgages were consciously approved for bad clients. What completely failed were the tranche ratings. And probably because correlation kicks in. Because that's the most sensitive parameter that we have out there, no matter which model you look at. Economic capital models, if you really want to rate securitizations, etc. So model risk is clearly a function of complexity. And you can have models covering a huge materiality in your portfolio, which are, and typically fall into your category A of being important. But they are not subject to an enormous model risk. Homeowners, right? It's affordability, LTV, interest rates. If you combine that in a sensible fashion, you're done, and you have backtesting results for this. So on top of materiality, be it in terms of exposure or be it in terms of RWA, you really need to ask the question, is there model risk? Not because it's material or something, but just the nature of the business. Is it really subject to a high risk that you can do something wrong or misspecify? And if you follow that line of argumentation, some of your models also drop from category A of being really having high risk, higher model risk, maybe they drop to category B or C, and you can save money because you don't have to look at it each and every year or each and every quarter. So I think that's something that we need to consider if we want to steer our resources efficiently in terms of model risk. Now, also part of the model risk discussion is a topic I really like, although I think there is a danger that people misinterpret what needs to be done here. So it's that concept of challenger model. In the SR 11.7 guidelines, you see the sentence benchmarking is the comparison of a given model's input and output to estimate from alternative internal or external data or models. So it gives you some advice that you should challenge what you do, your champion model, as they also call it. And also in the CCAR guidelines, intermediate holding company, capital adequacy, stress testing, also clear indication that you should work with challenger models. And a challenger model can be defined as an approach that is used to provide an alternative perspective and context of your champion model. And I think that's a really good thing. So you develop your champion model as you always did, but then you take a step back and you kind of challenge yourself what you did. That could be done by the first line of defense, second line of defense. But somebody needs to step back, look at it, and try to find a completely different approach of modeling the same risk. And I'm not talking about playing around with coefficients or maybe in a scorecard context choosing a different set of risk drivers. Really, look at it from a completely different angle. Use an option price model for your income-producing real estate business, right? And your LTV is the basis price. Do that. Try to find a completely different view on the same topic. And the pure fact that maybe your challenger model gives a higher output or a lower output is completely irrelevant. It's the process behind it. You have to struggle with both results. You have to explain why it is higher or why it is lower, to identify shortcomings of your champion approach. And what you sometimes hear is, oh, that's a good approach. Let's put it in a policy, how we deal with challenger models. Sure, but a challenger model should be something that is creative and should be picked case by case. So, but as soon as you put it in a policy, in this case we do that, and in this case we do that, you lose that flexibility. So really stick to this challenger model concept, because I think it's a crucial part of model validation and a crucial part of model risk, and you can learn a lot from dealing with challenger models. Second comment on challenger models, it again, like I said for the choice of the models, it depends, right? Sometimes you really should invest a lot of money into a challenger model. Sometimes you can just move ahead. And again, two dimensions you could look at is if you deviate from industry standards in your modeling techniques. Maybe you do something new, something that hasn't been done before or is not so well documented. That's certainly one dimension. And then, of course, the backtesting ability. Are you able to find a good benchmark to challenge your model? And of course, if you don't deviate from industry standards, you use a standard technique that people use for 10 years. I'm not saying that there is no risk involved, but in combination with very good backtesting data, you can do the bare minimum of challenging it, right? On the other hand, if you don't have data and you do something completely new, you yourself, right, from your gut feeling, you should invest more to get an alternative approach ready and challenge what comes out of your champion model. But here, what I want to show here is the concept is good, but apply it sensibly, right? Not one size fits all. Look at the situation and judge whether you really need a challenger model or not. Because otherwise it creates an additional burden that you don't want and probably you don't need in certain circumstances. And especially for this red square down there where you have no backtesting data and you deviate from industry standards, I want to discuss how a backtesting could look like. And that's just an example if we drill down a bit more. A definition of backtesting, of course there are some out there, but this is why: assess how the model output corresponds to actual observations, historic and current ones. And calibration is typically defined as if your measures don't align to what you observe out there, adjust the model, and that's typically called calibration. But what can you do if you don't have a long history of data and you still want to make a statement whether your model has the appropriate sensitivity or not? I think what we all have, at least maybe IRB banks, we all have a certain perception of what our expected loss is. We have 10 years of data, 15 years of data, maybe even more. And this we know. We have an expected loss. On the other hand, at least regulators have a view on how much capital we need to have on the side to absorb unexpected losses, which is the RWA concept. Right? And RWA times this hurdle rate of 8% gives you the capital, so the losses that your capital base needs to absorb. Or you even have an internal assessment of your unexpected losses, economic capital models, which I think many of us have in place. What you always could do is use those two measures to at least check the sensitivity of your model. If you plug in a very good scenario, you would expect that your model spits something out that is lower than your average default experience. And of course, if you plug in an average scenario, you would kind of expect that something around your expected loss comes out of the model, always considering some uncertainty around the model outputs. And that goes on and on and on. You take something, you look into your history, you take some scenario that reminds you of a 99% worst case scenario, and you would expect that you kind of end up in a range that is expected to be unexpected. And then, of course, the black swan, your model should also be ready to exceed those measures that you have in place if you plug in a really bad scenario. So this is a way to at least test the model sensitivity, whether it's roughly appropriate or in line with your regulator's expectation if you don't have anything. Okay. A final remark on stress testing in the context of its original purpose, and that was also related to we need to have something, we need to think out of the box, right? Beyond what happened so far, we need to have a flexible tool to play around with, to look into the future by assessing different scenarios, which I think is a good thing and we should do and we should keep doing. But if you look at it across the organizations, it seems to be the one-size-fits-all approach for all the problems that we have. We keep spending considerable budgets on stress testing functionalities, processes, systems, personnel. But if you really ask yourself the question, how did the learning curve in your organization develop in the last couple of years? Maybe I have some buy-in here, but my own experience is we had a couple of years where we really learned a lot. That's the blue curve, right? We started building first stress testing models and we had new insights. In the last 1 or 2 years, I have to say that the marginal insight decreased, right? Because it kind of, we got used to the magnitude of the figures, but there are also other reasons, right? The use test spirit of Pillar 1 kind of spilled over to the stress testing domain. Now you have to use those figures in your organization. You need to use it for incentivize business units, yeah? Risk appetite. You need to use it for benchmarking your Pillar 1 models. You need to use it for your balance sheet management, which comes on top of the original functionality, which was you wanted to have a flexible tool that you can be responsive to any sort of stress testing request. And what's the problem here? I mean, if you start the year and you incentivize your business units, and you do that partially based on stress testing results, And let's say in June, somebody comes up and says, oh, actually, I think we should also calculate another scenario, imagine, which is more severe, right? And all the business units are incentivized. They kept working for the last 6 months. Everything is working fine. And now somebody comes, has the idea of adding a new scenario. Imagine the perception in the organization. And that's a political thing. As soon as a figure enters discussions like this, it gets political. And a political environment was never a climate for creative thinking outside the box. Right? You need those figures to be stable because you have plans. You have PTIs planned over for the entire year. You have all sorts of dependencies that prevent you from being creative the entire year. And if the scenario is fixed, and if the methodology is fixed, in how far is that concept different from RWA? So the question that I want to discuss after my talk, or maybe even afterwards, are we creating an RWA in disguise? Sticky figures that enter processes, which basically was also the case for RWA at some point. So this, what I want to really get across is that this sandbox spirit that was there in the early phase of stress testing, we need to prevent this, because otherwise we are not a single step further when it comes to identifying future risks, because it's going to be too static. And we feel comfortable because we have all the processes in place. We can calculate any scenario in a day and feed it in various systems. But if you can't do it because processes are in place that prevent you from doing it, that's a different story. And as a final slide, because I hear the others clapping already, so that gives me a clear indication that I need to stop. That's a quote, right? The electric light did not come from continuous improvement of candles. Probably some of you know it. And to a certain extent, I think with all the measures that we take, be it stress testing, be it model risk, we are still improving candles, which is a good thing because they have to burn longer, they have to burn brighter, so nothing against that. But to really resolve the issues, we need to think maybe outside the box, and maybe it has nothing to do with improving models. And one example of improving candles is our incentive schemes, right? Deferred payments. Yeah, it kind of resolves the problem a little, but it doesn't cut to the core. An example of electric light is risk leadership, right? Role models out there who make people feel comfortable when they take risk-sensitive decisions, and that is risk leadership. Another example of electric light, and you can think of many things. What if you create in your trading desk, right? What if you make 5 of them, of your traders, mutually responsible for their actions, right? If person 1 screws up, person 4 suffers. Something that has never been done before, right? Try it. Maybe it works. Maybe it kind of gives an intrinsic incentive of looking what the others are doing, checking others. If we constantly just focus on models and the uncertainty around models and the uncertainty around the uncertainty of those models, I don't think we really cut to the core of the problem. It's all about people. People make mistakes. People make the wrong decisions based on incentives. And if you ask yourself, how much money do you invest in model risk frameworks, in validating models, and how much money do you invest in measures like I just mentioned, I think it's clear that it's strongly biased to model risk, model validation, and those things. Although it's a very important topic, but there is more in order to prevent future events. And that's basically it from my side, and I'm happy to answer questions now or later.